The CNBC app. Global market news in one place. Customizable sections and personalized alerts. Stocks tracking, interactive charts and market insights all in your hands. Stay connected. Stay informed. Download the CNBC app today.
Hello and welcome to Squawk Box Europe. I'm Karen Cho with Carolyn Roth, and these are your headlines. The US and Ukraine find some common ground on an updated and refined peace framework amid sharp criticism from President Trump and growing questions over the origin of the US plan.
The deadline is we want to get this done as soon as possible. Obviously, we'd love it to be Thursday. We'd love to be. Ultimately, the important point today is that we have made substantial progress. We've really moved forward. So I feel very optimistic that we're going to get there in a very reasonable period of time very soon.
Equity markets in Europe and on Wall Street look to kick off the new trading week in the green as New York Fed President John Williams says he sees room for a rate cut in the near term on the back of a weakening jobs market.
BHP says it is walking away from any last-ditch bid for rival Anglo American after news of a revived prospective takeover offer more than a year and a half on from its initial approach.
Geopolitics taking front and center this morning here in Europe as US and Ukrainian officials say they have made progress on a proposal to end the war with Russia after a day of talks in Geneva. The two sides say they have updated an earlier US proposal for peace, which called on Ukraine to cede territory and accept limits on the size of its military, with officials set to continue talks in coming days. The Secretary of State Marco Rubio and Ukraine's presidential office head Andrei Zermak have spoken to reporters about the negotiations.
I think today was worthwhile. It was very, very. It is probably the most productive day we have had on this issue, maybe in the entirety of our engagement, but certainly in a very long time. But work remains, and because this continues to be a working process, I don't want to declare victory or finality here. There's still some work to be done, but we are much further ahead today at this time than we were when we began this morning and where we were a week ago for certain.
We have very good progress and we are moving forward to the just and lasting peace. Ukrainian people deserve and want this peace more than anyone in this planet. We thank our big friends, United States and personal President Trump and his team to their commitment to bring this peace.
President Trump looked to increase pressure on Ukraine before Sunday's talks, posting on Truth Social that Ukraine had shown zero gratitude for US efforts and again criticizing Europe over continued purchases of Russian oil. Ukraine's President Zelensky sounded a positive tone on progress after yesterday's talks.
These were substantive conversations. A lot is changing. We are working very carefully on the steps needed to end the war. It is important that there is dialogue with the American representatives, and there are signals President Trump's team is hearing us.
Questions have been raised over the initial peace proposals presented by the US after senators briefed by Marco Rubio said they had been told it was made up of demands from Russia, which the US was presenting to Ukraine in an effort to broker talks. After those comments, Rubio talked to social media to say the proposal was drafted by the US, and Reuters has reported it was crafted last month at a meeting which included Special Envoy Steve Witkoff, Jared Kushner, and sanctioned Russian envoy Kirill Dmitriev. So a lot of geopolitics for the markets this morning, but it's also a massive one in terms of the consumer side. We've got Black Friday kicking off on the back of Thanksgiving, and we've got some data releases, retail sales and producer prices later this week, Carolyn. So it feels as though the markets are going to get served a lot to digest this week.
And remember, of course, good morning to you, Karen. Great to be with you this week out of Zurich. Now, it was a very turbulent week for U.S. markets last week. The major averages, they all lost roughly 2%. And we saw the NASDAQ falling for a third straight week. Let's show you what the markets, though, did on Friday, because we did see that rally, and that was largely on the back of John Williams' comments. We'll get to those in just a second. And they were pretty dovish, of course. The Dow Jones rallying by roughly 1%, the S&P 500 also up by a similar percentage amount, the NASDAQ up by 0.9%. All these concerns about AI overspending, the negative feedback loop with crypto, we'll see whether those will be put on the back burner this week as we see a holiday shortened week and some delayed U.S. consumer numbers. Now, let's show you what Asian markets are up to, excluding Japan, because Japan is closed for a public holiday today. We're seeing the Kospi a little bit underwater. The Hang Seng is surging to the tune of 1.8%. A large factor here, of course, Alibaba, the Hong Kong listed shares, after news of a strong downloads for its new app. We'll get to those numbers as well. And we're seeing that the Shanghai comp is pretty much flat today. Quick check of European futures. Remember, it was a downbeat week for European markets as well. Last week, the FTSE 100 and the rest of the major indices, they saw their biggest weekly drop since July, each down by more than 2%, given the volatility that we saw in global markets, of course. Now, this morning, the FTSE 100 seen bouncing back to the tune of 0.5%. The CAC 40 seen up by 0.6%. And the DAX, which is trading close to a 6-month low, is seen bouncing back as well by 0.75%. All eyes on the UK budget this week, of course. Now, I want to get back to some of the commentary, the dovish commentary that we saw last week, and that, of course, was the Fed's Williams on the rate cuts. Of course, New York Fed President John Williams, he issued a pretty dovish signal on Friday as he advocated for a rate cut in the near term. The Fed official said he still sees room for a further adjustment, as he argued that policy is modestly restrictive. Williams is, of course, a voting member this year and is considered part of a leadership group that includes Chair Powell and Vice Chair Philip Jefferson. Meanwhile, Boston Fed President Susan Collins, also a voting member this year, told CNBC she would be hesitant to back more cuts.
I think a mildly restrictive policy is very appropriate right now. And that is part of that relatively benign outlook that I just laid out, which is my baseline, because it helps to ensure that as tariffs work their way through the system, we really do see a return to that overall disinflation that we were seeing, many months ago.
Let's get more analysis on this and all things global markets with Nicholas Brooks, Head of Economic and Investment Research at ICG. Nicholas, thank you so much for your time this morning. A lot to digest over the weekend as well. Let's put the Ukraine discussions to the side. Let's take a look at what's been moving the markets in a good way on Friday. And of course, those were the dovish comments from the New York Fed president. Are we reading too much into this at this point, given that the Fed is so incredibly disjointed?
Yeah, I think actually we are reading a little too much into this. It's incredible how quickly sentiment changes. Last week was a perfect example. Earlier in the week, as you know, the pricing in the swaps market for a Fed rate cut in December was, close to 30%, a little below 30%. And then we have these comments from Fed Governor Williams, and all of a sudden, expectations for December cut are over 60%. So, clearly there's a lot of uncertainty about what the Fed's going to do. And I think part of that, of course, is because of the government shutdown and the lack of data. So I think everybody is, just trying to second guess, get into the heads of the Fed members, and it's really hard to do when you don't have a lot of data.
Absolutely. We're all flying blind to some extent at this point. This week we get September retail sales. We get durable goods numbers on Wednesday as well. What sort of a picture do you think these economic data points will paint when it comes to the U.S. economy and the need for the Fed to cut in December?
Yeah, again, it's tough to predict, monthly data, but overall, I'd say the U.S. economy is actually doing really well. I mean, third quarter GDP numbers look on track to be, at the moment, if you look at the Atlanta Fed GDP Now data, you're looking at something close to 4% in the third quarter. Now, I suspect that's going to come down into the threes. But when you're looking at GDP growth of around 3 point something in the third quarter, When you're looking at inflation at around 3%, well above the Fed's target, services inflation still pretty high. I mean, I would argue there are not a lot of reasons to be substantially cutting rates. So, whether we get a cut in December or not, I don't know. But I would argue that, most of the data, if I was sitting on the FOMC, would tell me maybe hold off for a bit and wait and see what happens.
Nicholas, this week to me looks a bit like driving a car. We're looking backwards in the rearview mirror to see what the data looks like behind us. We're talking about whether we're changing lanes because we're looking at incoming data on the holiday season right here and now. Black Friday, where the consumers are loading up on discounts because they're worried about the tariffs as well, or whether we've had any impact from the fallout of the market route. The luxury, the high-end customer has been holding up a little bit more, but do they also get upended by some of the market selling we've had lately, impacting the wealth effect? So to me, it seems like we're in the car and we could be changing lanes around a rate cut. We may not be. We're looking backwards at the data. We're looking forward at consumer patterns. I mean, it's a tricky one, isn't it?
No, it's very tricky. And I think that's why we're seeing so much volatility in the market. I mean, again, last week was a perfect example. We're flying slightly blind. We are potentially at a turning point. I think that's why everyone is expecting the Fed to cut rates, because everyone seems to think that we will see a slowdown in economic growth. But I would argue so far the data doesn't indicate that. So, if I were to say what's the biggest risk out there, I'd say the biggest risk is that we don't get the kind of rate cuts that investors are expecting. And that really has been the key driver of markets over the past few months. So if you look at real rates versus the S&P 500 or against a lot of other assets, including crypto, you're going to find there's a high correlation, a high inverse correlation. So I think that, in the near term, I think there are some risks to the market because I think people may be over-egging how quickly the Fed's going to cut rates.
Well, that's the point, isn't it? We're looking for weakness in the data thanks to the labor market, but in some ways it's not forthcoming. I mean, even over the weekend, the latest consumer patterns we saw was that it was a blockbuster weekend at the cinema as Wicked 2 kicked off. I mean, if we roll into Black Friday and Cyber Monday and US consumers again show some resilience, doesn't that sort of push back against some of the fears of cracks and fragilities in the US economy?
Yeah, absolutely. So, I mean, I don't see many cracks in the U.S. economy. So we did see payrolls come down pretty sharply, and we saw those backward revisions. I think that's where there was a big change in sentiment towards the Fed. But again, the most recent payroll numbers that we got were actually pretty decent. Unemployment picked up a little bit, but the payroll numbers were pretty strong. So, my view would be that, I think we've kind of over-egged it, especially in the tech sector, especially on the AI side. But as I look into 2026, I think the structural fundamentals are actually pretty decent. Consumer balance sheets in aggregate are pretty solid. Corporate balance sheets in aggregate are pretty solid. Systemically important banks are well ring-fenced and have, very good capitalization. So, possibly we see some moderation in growth in 2026. I think that's what a lot of people would actually hope to see to kind of cool things down and let inflation come down. But structurally, I think the fundamentals are pretty good. So I could see some more volatility, potentially a sell-off on the AI stocks. But as we move into 2026, when I look outside those areas, actually valuations don't look that bad. And I think structural fundamentals are actually pretty good.
Nicholas, I want to come back on some of the comments you made here on crypto and AI, because in the 24 hours leading up to Friday morning, we saw more than $2 billion worth of crypto trades being liquidated. And we know that has been feeding into the sell when it comes to the big tech names, including NVIDIA, of course. To get a better sense of whether the selling in the equity markets can be arrested, do we just have to look at the signals when it comes to leverage in the crypto markets? And do we know, or do we have clarity on what the leverage levels are like at this point? Because it really was a cascade of selling.
Yeah, no, absolutely. I think, we don't have a lot of clarity on the leverage. We don't have a lot of clarity in that market in general. I would argue, though, that it is, in my view, a pretty speculative area. It's gotten pretty frothy this year, very similar to many of the AI stocks. And I think a lot of what's driving the outlook is expectations for short-term interest rates. So again, if one has a view that the Fed's going to be able to cut pretty aggressively, which would not be my view, then possibly we'll see some stabilization and rebound. If you think that actually growth is pretty solid in the U.S. and inflation is still kind of sticky, and maybe Fed rate cuts won't come as quickly as investors would like to see, then possibly we'll see further declines. I'd probably be more in that camp.
If I can pivot to Europe, because there's a compare and contrast here. Some irrational exuberance may be shaken out of the US market around this AI story. But if you look at Europe, we had already moved into a sideways pattern in recent months on the stock market. And with some of that momentum lost stateside last week, it really undermined the direction of European stock markets as well, as we set up this morning for what could be a major geopolitical event again around the war in Ukraine, whether there's any progress here. If there happened to be progress, how do we think about the upside potential for European economies and the European markets, because it feels as though we've really got a year-end fade that's kicked into European stock markets?
Yeah, I mean, I actually would be more bullish on the outlook for Europe for a few reasons. I think number one is we've seen the ECB cut rates by over 200 basis points over the past 12 months, and monetary policy works with a lag, so I think that will feed through into the economy in 2026. I do think Germany and a number of other countries are quite serious about the fiscal spend. So I think we're going to see a little more expansionary fiscal policy in Europe. Obviously, France and Italy will have some issues, but there are a number of countries that have the potential to increase fiscal spend, as well as Germany. So we're getting fiscal stimulus, monetary stimulus coming through. And if you look at valuations across, let's say we use the Euro Stoxx 50 as a proxy, stocks don't look that expensive relative to history. So again, the issue always is with Europe is, often the companies don't seem quite as exciting as the companies in the U.S., particularly in the technology sector. So the U.S. S&P 500 has tended to outperform Euro stocks. But I think when you look underneath the benchmark indices, there's a lot of good value in Europe. And
this is a market that's been looking at diversification, and those messages are hitting home in recent weeks and months. Thank you so much for joining us so early this morning, Monday morning. Nicholas Brooks with us, Head of Economic and Investment Research at ICG. Coming up on this show, we're going to cross out to Johannesburg for the latest from a G20 summit overshadowed by a US boycott. Plus, we look ahead to Wednesday's budget with continued uncertainty over the UK government's fiscal plans. And we'll have more on US-Ukraine negotiations with Ukrainian MP Alexei Gorekchenko, who is coming up at 8:45 London time.
I'm Steve Sedgwick from CNBC, and in my new podcast, Executive Decisions, I ask powerful leaders about their decisions that changed everything.
I'm not frightened of making tough decisions, and I think leadership can be very lonely.
Business leaders should not stay quiet in a world which is super complex.
It is absolutely fine to also change your mind.
Tough calls, personal crossroads. These are the stories that we can all learn from. It's Executive Decisions from CNBC. Get it wherever you get your podcasts.
Welcome back to the show. The future of a peace deal in Ukraine also loomed large at the G20 summit in South Africa. President Zelensky held phone calls with leaders of the UK, France, and Germany after a leaked US-backed peace plan suggested that Ukraine may have to cede territory to Russia. This is what European leaders had to say about the proposed Ukraine peace plan at the G20.
I think it's very good that the US proposed something to go to a ceasefire and peace, and we have to commend these efforts. But at the same time, as what is at stake is obviously Ukrainian sovereignty and European security, it's normal to have both the Ukrainians and the Europeans on the table to finalize this plan. So this is exactly what we will do tomorrow and the day after in order to make a common plan.
It is important to keep firmly in mind what we're all trying to achieve, which is a just and lasting peace. But also underpinning that is the principle that I've always adhered to, that all matters about Ukraine must be determined in the end by Ukraine, and that's why we're talking very regularly with the Ukrainians.
I have said this several times to the President of the United States. I think the Russians need to give some concrete sign that they actually want to achieve peace, because everyone else, the Americans, Ukrainians, Europeans, Turks, is doing their part except for the Russians.
There will now be further consultations. Foreign policy advisors from the Group of Three and other representatives of the European Union are now on their way to Geneva. There will be further consultations in Geneva tomorrow with representatives of the American government and with representatives from Ukraine. And I want to make it very clear, in this context, an end to the war can only be achieved with the unconditional consent of Ukraine. Wars cannot be ended by major powers over the heads of the countries affected.
G20 leaders have issued a joint communique that hailed their commitment to, quote, multilateral cooperation in a summit that was boycotted by the United States. South African President Cyril Ramaphosa said the declaration showed that the group's shared goals outweigh their differences. Let's get more perspective from CNBC Africa's Godfrey Mutizwa, who joins us now on the ground. Obviously, this was a very special G20 in the sense that it was hijacked by the Ukraine negotiations. Godfrey, it seems as though we have an issue with your line. We'll come back to you once we re-establish your line. Karen, some really interesting comments coming in from the German foreign minister here, saying that the Geneva talks produced a, quote, decisive success. Let me just bring you more from his commentary. All issues concerning Europe, including those concerning NATO, have been removed from this plan. This is a decisive success that we achieved yesterday. A lot of consternation on the European side, obviously, as President Donald Trump tried to ram through his plan by Thanksgiving.
It's been an eventful weekend, hasn't it, where we've seen this plan, the 28-point plan put forward from Trump. That, of course, requiring some huge sacrifices from the Ukrainian side, the Europeans pushing back, and now we have a further framework. But let's circle back to Ukraine in just a moment and get out to Godfrey for more on the G20 and a lot of messages about multilateralism. Godfrey.
Thank you, Sylvia. I hope you can hear me this time. Indeed, yeah. So South Africa really, I think, just concentrating on the fact that they were able to get the rest of the G20 to agree to that joint declaration and very much making the case for the continued existence of multilateralism, despite, as we know, the absence of the United States. Then, of course, there was Argentina, which did not object to that declaration, but was not represented. So a lot being made about the fact that, in the end, President Donald Trump was able to insert himself, as it were, into the program, even though he wasn't there with his proposition of his plan for Ukraine. So we had the Europeans at some point hurdling, if you like, and talking about that peace plan and issuing their own position on it. And then on the other side, you have the group bringing together the developing South. And they very much focusing on the issues that they would like to see addressed. So their hot button issues, of course, include climate change and plus, of course, climate finance. And then there's also the issue of debt relief. This is a big issue for the African continent, without doubt. Figures coming through from the International Monetary Fund showing $100 million is owed by developing countries. And then when you look at the African picture, and particularly, it's especially dire. You're talking about more than 20 countries that are in or near debt distress. These are IMF figures. So this is an issue that they would like to really see addressed. And I think it was emphasized at the weekend when we heard news that Zambia had actually just about exited debt default. They'd been negotiating for years and years about this important issue. The other issues the Africans in particular wanted to emphasize was around critical minerals and, of course, the energy transition. They were able to insert that into the declaration. It is certainly hoping that they will be able to carry it to the U.S. But that is, of course, a big question because we know the U.S. is very much opposed to some of the ideas that were set out by South Africa, including its three broad ideas around equality, sustainability, as of course solidarity. So it'd be interesting to see what then happens. I think one of the other interesting stories that came out of the weekend was President Macron of France coming up and suggesting that perhaps the G20's time had outlived its usefulness. It did not find much traction because I also picked up from the German Chancellor speaking about the fact that he thought there was still a lot of room for multilateralism to exist, and therefore they did not see it the same way. So lots of thoughts coming out, but for South Africa, Sylvia, I can tell you the declaration is that this declaration is a G20 declaration, and it was broad-based.